Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us about the major meltdown by the major equity markets and how the Canadian dollar has been holding up remarkably well despite lower oil prices. Dr. Marc Faber checks in from Thailand and reports on the coronavirus, the Chinese economy, precious metals, and how much do corrupt governments suck out of your wallet. Discovery Watch's John Kaiser tells us about the mood at the PDAC mining conference in Toronto and how there's a drive to get younger investors interested in mining instead of pot and cryptocurrencies. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at Charts by Ross. Welcome back to the show, Ross.
Good to be with you, Jim.
Well, when they say, may you live in interesting times, it looks like the equity markets are very, very interesting.
Yeah, and another week for the record books. We go from FOMO, fear of missing out, for the whole month of January into February, and then it gets us into the GMO, which is get me out. But the volatility of this last couple of weeks just, we haven't seen this in years. I lived through some of this, when we came off the top back in 2008, and on the way down, I think of October of '08, a real thrashing around before the eventual bottom. The same type of things as you came off the dot-com bubble. A lot of volatility in the early stages. The key that we need to watch for at this point, and clearly the market already had internal fundamentals that were questionable, but the COVID-19 has now become the catalyst to get this market as a whole under pressure and to get the fear in people such that the two main asset classes that you would expect to do well have done well, that being gold and U.S. Treasuries. So what I'm looking at is that there's a pretty key support level here that we bounced off of a week ago, came back down and retested it right at the end of this week, both in terms of the percentage decline and in terms of moving averages. The 20-month moving average is a key that we keep an eye on. And from the seasonal perspective, we were looking for this pressure to come into play, regardless, in a presidential election year. The first break is normal. Magnitudes are always questionable. In this case, it was as weak as one could possibly expect. Actually, it's similar to 2000 and 1980 as we came off the tops in terms of how hard they've broken. And the bounce midweek this week, 50% retracement of the initial decline, and then back down at the end of the week to test the low. So this whole process from the high close is only 12 days now, 12 trading days. And before you've got a chance to put in a really good tested low and bottom, that typically takes 30 days, as we've been talking about. So we're maybe only a third of the way into a potential bottom. However, if this thing starts to grow on itself, the next big level of support would be a 38% retracement of the whole bull market run from 2009. And that's still about 20% below here. So you never know how the economy is going to move along here as far as the number of events and things closing down, the travel changes that people are making, both for tourism and for business. So, as a technician, I will look to see if we can get some characteristics that look like a bottom. And even though it's a decent bounce at the end of the day on Friday, it doesn't look like it's there yet.
Now, we've had, during this 12-year bull run, there have been major corrections along the way, and everybody's asking, is this going to be a 20% correction, then it's off to the races again, or is this really a meltdown?
Well, I try not to make those calls. Be like, calling the bull market in March of 2009. Along the way, there were lots of good opportunities, and as to buy corrections and sell rallies. What I look at right now is that this break is sharp enough to create a low, but I don't think a major low yet. You really, after a run such as this, historically you need that 38% retracement before you can put in the next lasting low. I've talked about the bull market run in the 1950s. So that was 1949 to 1961, the 38% retracement there. You had the rally from 1974 until 1987. 1987 was a 38% retracement into the crash. The same thing when you came off the high in 2000. That had been the run from 1994, and that first break into the 9/11 break into September of 2001. That was the 38% retracement, and because of the lasting impact that it had as far as the economic conditions were concerned, then you had the next leg down into 2002. So this correction right now clearly looks like it will end up needing a deeper break than we've seen as of yet. So if we can give up another 20%, and it doesn't have to be in the next month or two. I mean, it could take a period of months. But if you do that, I think you can set up for something that would be, much better on the upside. But I wouldn't hold your breath at this point. We take a look at the other extremes that are out there. The bond market, my gosh. Here you've got 10-year rates down to all-time lows at 0.7%. You've got the 30-year down to 1.2%. At all-time lows. And these, when you look at the 40-year channel that we've been in here of declining interest rates, this is right now at the bottom end of that channel. You're starting to see some real extremes when you look at things like the relative strength index and in any of the other oscillators. So pretty good chance for a bounce as far as the rates are concerned, but like anything, this is far from over as far as that one's concerned.
The Canadian dollar down to 74.5 cents. America now, is that good or bad considering what's going on around the planet?
I think it's been just exceptionally buoyant considering all that's going on. You've got, we had looked for, the oil to possibly bottom out there around $50 and stage a bit of a rally. Well, it got to 54. Basically, the top of its bounce coincided with the top of the equity markets, and then COVID came into place. If you take a look at the Canadian dollar, it had the same bounce with the oil market into that February the 20th, 21st, and it really hasn't given up all that much. So percentage-wise, the Canadian dollar, I think, still ends up looking vulnerable. And also, you take a look at it relative to the commodity indices, the agricultural index, the DBA ETF. That's taking it on the nose. From you take a look at investment. My gosh, here you've got Teck deciding to bail out of the mining in Alberta, a week and a half ago. And then in the last day or two, you've got Buffett saying that they're going to pull out of this $4 billion investment in LNG in the Saguenay. So it's, to me, the Canadian is, it's in a downtrend, and just think of it as an item that, anytime you get a bounce in the U.S. dollar, which in itself has been weak here, you get a bounce in the U.S. dollar, the Canadian's probably going to take it on the nose pretty hard.
Gold and silver, are they still going strong, or have they pulled back a bit?
Well, it's been a great run in the gold market, choppy to say the least, but it's been a good safe haven. You've got $1,670 US to close off the week, so that's the highest close that it's had in many years. In any other currency, I guess, other than the Japanese yen, you're sitting at all-time highs and continuing to move up. The gold-silver ratio, you're around 96 right now, and that's getting up to an extreme. I think back in the mid-1990s we saw it get up to 100. But silver being I call it a semi-precious because it's got much more of a manufacturing aspect to it in terms of usages. It's to me it was stuck inside that trading range. Could not manage to get any life above 18.5. So breaking 17.5 down to 16.5. I just don't see that silver's got much life in it right now. Maybe we'll look at it as we get closer to the summer, but you're past the seasonal favorable period here. So I think more of a thrashing market for silver and gold. My target is still 1888. That measures the size of that 5-year base and just the measurement out of there. The first target's at 1566, held well. The next ones are still $200 above here. So I think as long as gold wants to just stair-step its way up, there's no reason to be taking it off the table.
Ross, thank you so much for being on This Week in Money.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can also find him on Twitter at Charts by Ross. Coming up, Dr. Marc Faber, next on This Week in Money.
Always consult your investment professional before making any investment decision.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report online at gloomboomdoom.com. He's speaking to us from Chiang Mai, Thailand. Marc, welcome back to This Week in Money.
Well, thank you very much for having me.
Marc, we're hearing the coronavirus is turning into a pandemic. We also hear it might be kind of a hoax, maybe perhaps just to control the unrest in Hong Kong and in central China. What are you seeing and hearing?
Well, I'm sure that it has really nothing to do with the demonstrations in Hong Kong, and I think it has very little to do with what you call unrest in China, because in China there wasn't any unrest prior to the coronavirus. So I think it's either coming from, as people claim, from a meat market in China, or, as I believe, it's a manufactured virus that is extremely contagious and will travel throughout the world. And I'm actually surprised. Actually, I'm not surprised because I think the WHO as an organization is another one of these useless UN organizations in the world, which is very politicized. So I'm not surprised that they haven't declared it a pandemic. But 100% it's a pandemic. There's no question about this.
Is the coronavirus a black swan for the markets, or were the markets just due for a massive correction anyway?
Some people have, argued, don't worry, it's like SARS in 2003. But to this I respond, when SARS occurred in the first few months of 2003, the market, say the Nasdaq, had just declined by 80%. From the peak in March 2000 to the low in October 2002. And by early 2003, the market had somewhat recovered, but then it fell again in a sell-off where stocks, or some stocks, would make new lows. So we were at the bottom of a stock market cycle. Now we are 11 years into a bull market in 2 days. That will be March 6, 2009, the beginning, S&P 666. And in June, we would be 11 years into an economic expansion. So we're at the tail end of a very rapid and powerful expansion in stock prices and in credit, not so much in the economy, which was driven by money printing and by huge fiscal deficits, as you know.
Volatility has hit the stock markets. This is an election year in the U.S. How do you see that affecting the markets going ahead?
Well, I've been thinking about this because, the saying, or some people think that Biden and his kind of conventional democratic crowd will try to steal the election from Bernie Sanders. I think in general that Bernie Sanders would be essentially the chosen candidate if it came to people, but maybe we'll get a brokered convention and they will again eliminate Sanders the way essentially Hillary Clinton stole the nomination away from Sanders 4 years ago. Now, personally, I think that again the view is that Sanders would be negative for stocks and Trump would be positive. I'm not so sure. I think under socialist governments, usually stocks have actually performed quite well, certainly in Europe. Whenever a socialist government came in, the stock market rallied because socialism means money printing and large fiscal deficits. So it's difficult to tell, and some people would be concerned that if Trump is elected again, that the second time around he will make bolder moves and more mistakes. Because as you know, he's not a very thoughtful person. But it will create volatility, undoubtedly.
There are calls for President Trump to reinstate the full uptick rule. If the uptick rule was reinstated, would anyone suffer besides the predator short sellers?
I don't think so. We had an uptick rule in the 70s, and the 70s and early 80s were actually the most successful years for short sellers. So I don't think that an uptick rule would really matter all that much.
This week, the Fed cut the bank rate by 50 basis points. Could the U.S. see negative interest rates?
Well, we have negative rates in Europe. I can give you an example. If you buy 10-year Swiss franc government bonds, they have a zero coupon. In other words, you don't get any interest for 10 years. And today you would pay 115. So in other words, you pay 115 today, and in 10 years, the government will pay you back 100. So these are steeply negative rates. They don't help much. In fact, they probably hurt consumption more than they help. They hurt insurance companies. They hurt the banks. And so, yes, the U.S. can go to negative rates. Will it help? I doubt. Number two, say you can go on negative rates when it comes to government paper, in other words, treasuries. But will there be negative rates on junk bonds, on high-yield bonds? Of course not, because once you have negative rates in the system, it means the economy is rather weak. So the spreads will widen, and as you may have heard, at the present time, on credit card balances, the interest rate is at the record high level. So the negative rate actually only help a few people. It helps the government, but it doesn't help most of the private sector.
The gold market is seeing volatility. Is this a sign the gold market could be headed higher or lower?
Well, I wished I knew the answer to this question. I think the gold market, in theory, will probably head higher at some point. But we have to realize we had actually a good move from a low of around 1,000 in December 2015. We are at 1,600. So I think that the gold price is about where it is. Personally, I'm a large holder of gold, and I think eventually it will be higher because of the irresponsible central bankers that we have around the world, that with their policies are likely to make things worse rather than better. But I'm not overly bullish in the near term. The commercial were heavily short gold just recently. They may have covered some on the setback last Friday, but they wouldn't have covered everything. So my view is that, yes, I'm long gold. I have no intention to sell my gold, but we have to be aware that in an environment that could be very deflationary as a result of the coronavirus scare and the weakening global economy, as a result of that, we could have a decline in all asset prices, not just stocks, but also commodities and in art and in collectibles and in lower quality debt. The higher quality debt, I think, is okay, but the higher quality debt is already very expensive. In Europe, we have negative rates, and in the U.S., the 10-year Treasury is now at the record low yield of 1.04%.
Silver is also seeing volatility. What are your thoughts on silver?
Well, I look at precious metals as a basket, whereby probably silver is cheaper than gold, and platinum is even cheaper than silver compared to gold. But it seems that at the present time, the one that moves, or the one that is favored by investors, is gold.
Following the rate cut by the U.S. Fed, is the U.S. dollar still the safe haven currency for the foreseeable future?
There's no paper currency that is a safe haven, and I think that the U.S. dollar, if you look at the fundamentals of the U.S., the U.S. dollar is high, is expensive, and I think the rate cuts of the Fed will accelerate the decline of the dollar against other currencies. But as you've seen today, the dollar doesn't go down a lot against the euro, but it goes down a lot against gold. So I think when you look at the dollar and other currencies, if you want to diversify, probably your best option is to be in a currency called gold, silver, platinum.
Crude oil, your thoughts on that?
Well, crude oil, as you know, is driven by demand and supply and by political events. I think we're unlikely to have a peaceful Middle East anytime soon. And at the same time, demand is obviously weakening. You know, if people go out less, if people travel less, if people go less on cruise ships. In fact, I would advise all your listeners not to go on any cruise for the foreseeable future. But all this leads to lower oil prices. in China, we had a record collapse in the PMI, and the industrial production is way down. I mean, not just down 3% or 2% or 5%, but down like 40%. Some industries are almost at a standstill. So under these conditions, the demand for oil obviously goes down very considerably.
Are the repercussions of China's money printing starting to take hold?
Well, it's a long story, but basically China has expanded its debt as a percent of the economy at a faster rate than any other country prior to a major financial crisis. So we have a very over-leveraged system in China, and unless the government steps in and bails out thousands and thousands of businesses, these businesses will go out of business because they have no customers at the present time. So I'd say we may be at the beginning of a financial and economic crisis in China.
Will the coronavirus be used as an excuse for China's failing economy, or was it doomed to have a downturn anyway?
I think it was due to have a downturn anyway. Part of it's coming from the trade war, and part of it from a slowdown in demand. I mean, if you look at, say, car sales in China, they've been going down for 18 months. This has nothing to do with the coronavirus, and it has nothing to do with the trade war. This has to do with domestic consumption. And so also I observe the economies here in Asia because I travel around a lot the Asian region. I can say that the economies in Asia began to slow down 18 months ago, 12 months ago, and were hardly growing anymore before the impact of the virus.
We'll have more with Dr. Marc Faber when This Week in Money returns.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Marc Faber. Marc, President Trump recently met with India's Prime Minister with the theft of intellectual property and buying of American politicians by China. Could President Trump favor trade with India in place of China?
I think his friendliness towards India is based on geopolitical consideration. He thinks that by siding more with India than with China, there is counterbalancing power in Asia. I don't think this is the case because the Indian army is not as well equipped as the Chinese are, and India in terms of GDP is of course much smaller than China is. But this is the case that he has a preference for Modi. Modi in India is not an entirely a satisfactory prime minister, and he's very dictatorial. I mean, the whole valley of Kashmir, which is essentially of Muslim faith, was isolated. They cut off the internet and so forth for 3 months or more. So he's not exactly a nice person, but he's probably the best option for India at the present time. The Indian economy has been slowing down also, and is not going to provide the world with any growth in the near future. But in the long run, obviously, we have a massive pool of knowledge in India, particularly mathematical skills, that would be useful for the U.S., for the entire U.S. software industry, for banks, because a lot of back office functions of banks have been outsourced to India. So essentially friendliness towards India is based on geopolitics and also on his administration anti-Chinese bias.
Chapter 27 of the USMCA agreement targets corrupt politicians in Canada, Mexico, and the U.S., though Canada has yet to sign it. If finally signed by Canada, is this a win for the people of Canada, Mexico, and the U.S.?
Well, first of all, when you address the issue of corrupt politicians, I think the political system today, and this is a byproduct of democracy, has become incredibly corrupt. And one of the problems of democracies, nobody really personally is responsible for the actions. It's always hiding behind the deep state. And so nobody really gets convicted. I mean, in America, the good thing about the elections and the good thing about the impeachment process has been that the public has really seen how corrupt Washington is. And no treaty in the world will change the corruptness of politicians in Washington. But it also has to do with the size of the government expenditures. You know, you look at America, the budget deficit, in other words, the federal fiscal deficit is $4 trillion. No, sorry, the total expenditures are $4 trillion. The deficit is about $1 trillion. But say, if you look at all the countries in the world and you look at them on a scale of being very honest and very dishonest, the governments. So you have among the very honest governments, Norway, Sweden, Finland, Denmark, Switzerland, probably the Netherlands, and under the very dishonest countries, you have all the African countries. So in the very honest countries, basically the theft is maybe about 5% of government expenditures. In the most dishonest countries, it's 90%. So the U.S. is somewhere in between. It's not the most honest country, but say, if you're an optimist, you will say in the U.S. they only steal 10% of government spending. So on a $4 trillion government spending annually, that would be $400 billion. Now imagine 400 billion U.S. that goes into corruption. Now you may say, well, the U.S. is the most honest country in the world. So okay, then 5%, still $200 billion annually. So all I want to say is the larger the government expenditures are, the more corruption there is.
Exports and business investment are dropping in Canada. Is this a sign Canada is already in a recession?
Well, this is a good question. I think there is no economic growth at the present time in Canada. I think the real estate markets have been weakening. And, maybe like the stock market goes down and then there's a rebound and then it drifts again lower. So in Canada, maybe you have a rebound in some property prices and then you head lower. But in general, the Canadian economy is also tied into the global economy. And if the global economy is in recession, then for sure Canada is also in a recession.
This past week, the PDAC convention in Toronto had hundreds of anti-mining protesters and protesters claiming to be in support of northern BC natives in Canada have been blocking railways and city streets for weeks without any police intervention. Is this the sign of a country being deliberately destroyed?
Well, we have democracy, and we have to accept in democracies the fact that some people have the right to demonstrate. We have the right to demonstrate and to express different views, and that is one of the problems of democracies. It's also probably one of the strengths of a democracy. But you cannot dismiss these demonstrators as being totally wrong. I mean, they have a view. I may not agree with that view, but they should be given the right to express their views. Now, the protests also in Hong Kong are acceptable as long as they do not destroy public property or private property. So in other words, if the demonstrators in Hong Kong destroy the railway system, the subway system, and so forth, that is not acceptable and should be punished very heavily, because that was paid by the taxpayer, and the demonstrators should only demonstrate peacefully, not with violent actions. Ditto in Canada, if they close down train stations and roads, this can lead to accidents, so it should be condemned.
Is consumer debt and overall debt the elephant in the room?
Well, the consumer debt, as you know, is very high. On statistics, they claim that it's not that high because as a percent of disposable income, it's not at the peak. But I'd like to make here a very clear statement. The problem with the consumer debt is that it's not evenly distributed. The consumer debt, and especially the low-quality debt, student loans, car loans, and credit card loans, are among low-income groups. And the high-income groups, say the 1% richest of Canada, the U.S., and so forth, they don't have consumer debt. They may have a credit card for convenience, but not to borrow money. And they can pay off the credit card debt any time. It's not that they have to wait for a salary at the end of the month to pay off the credit card debt. You understand? So the problem is that the large part of the population that consumes, say 80% of the population, they have large debt and they have incomes that have been stagnating, and so their ability to consume more is kind of mortgaged away already. They can consume but not increase their consumption dramatically because they're too much indebted.
Where is international capital currently flowing?
Well, if you look today, the capital is flowing into the gold market and into U.S. treasuries, but tomorrow may be different. So, this will lead to the volatility we alluded to before.
With the U.S. Fed lowering its trend-setting rate by 50 basis points, could there be a big spring bump in Canadian and U.S. real estate?
Well, the real estate market is a complex issue because in the last few years already, the trend has been for more and more people working from home. This is an established trend, okay? Now, with the coronavirus, the companies, the corporate sector is telling people, don't come to the office, work from your house. So more and more people will start working from their homes and no longer go to the office. And when the whole coronavirus is off, the companies may say, well, our business actually worked better when people were not at the office because they worked from their homes and their productivity working from their homes increased. They didn't waste time coming to the office every day and waste time going back home and so forth. So let's move to more and more flexible hours where people may come to the office just once a week and the rest they can work from their homes. That then has an impact on your life. In other words, take me as an example. 20 years ago, there's no way I could have lived and worked out of Chiang Mai. I would have to be in a financial center, Singapore, Hong Kong, Tokyo, New York, Los Angeles, or London, or Paris, Frankfurt. But now I can be, essentially, I'm in a city center, but in the north of Thailand, but I could also be in the countryside in Thailand. So in Canada, in Europe, what this means, and in the US, is that someone could go and live in the countryside in the middle of nowhere, where real estate is still a bargain compared to city center, Toronto, Montreal, Vancouver, and so forth. And he could do his job as well as someone who is in the city center. So over time, I think there will be an arbitrage with real estate in the countryside of Canada, the US, France, Italy, Portugal, Spain, and other countries, Eastern European countries going up, and the city center properties will, the so-called commercial properties will be unattractive also because the coronavirus is going to change shopping habits that they have been changing among young people already, with most young people buying online. But the coronavirus will drive even more people doing e-commerce and buying online than going to a shopping street or a shopping center or department store. So I think these are very important trends that are not caused by the coronavirus, but the coronavirus is accelerating these established trends already.
Where are the best places to live in the world where people enjoy the most freedom?
I think that people are in chains, but they don't notice that they have no freedom. So I don't know where people have the most freedom. I think if you stay out of politics, then in Asia we have a relatively high level of freedom. But obviously you cannot write, or say, I cannot write an article that is very critical of Thailand in a Thai paper, nor would I do that in a foreign paper. So that comes with a relatively high level of economic freedom. I think that in Europe we have relatively high freedom, but the expression freedom is frequently misunderstood. Freedom comes with responsibility. And if you have personal responsibility, this responsibility essentially compels you to give up some of your freedom. So I think it's very important not to misunderstand the expression freedom. People have to think very carefully, what is freedom? In some countries, freedom from hunger and sickness is a lot of freedom. In other countries, freedom from oppression through the government is very important. In other countries, you have freedom, but if people always ask, well, the government should do this, the government should do that, then if the government does everything, you're no longer free. So I think this notion of freedom is a very nice ideal, but people don't think it through.
Overall, are you seeing gloom, boom, or doom?
Well, I think the global economy, and these are my personal observations, is already in recession. I think the coronavirus will not be over in 2-3 months. I think the impact will be long-lasting, and it's hitting a global economy that has been slowing down for the last 18 months. It's kind of the final push, the nail in the coffin, so to speak. And as you can see today, the markets are down, although the Fed fund rate was cut by 50 basis points. I don't think that rate cuts at this point are useful. And then we have the election coming up that creates also some uncertainty. We have a market that is very questionable in terms of the latest rally from October to recently, to 10 days ago, because it was driven by very few stocks. Momentum stocks, the FANG stocks, semiconductors and so forth, and Tesla. And the broad market didn't participate.
Mark, can you tell us about the Gloom, Boom, and Doom report and how people can find out more about it?
Well, I have a website, gloomboomdoom.com, all in one word, and I have 2 reports. One is a printed report, the Gloom, Boom, and Doom report, and one is a website report that goes out monthly by email. And I would say, usually for individual investors, the website report is sufficient.
Mark, thank you so much for being on This Week in Money.
Well, thank you very much for having me, and let's hope that we all don't catch the coronavirus.
Well, I'm lucky I get to work from home.
Yes.
My guest has been...
I can send you an envelope, and if I have the coronavirus and I touch the envelope, you could get the coronavirus because it's a bug. It's a virus that can live on surfaces.
Something to keep in mind. That's why we are supposed to wash our hands.
No, the best is to talk through the phone and not send mail anymore. It's very bad for the post office.
Mark, thank you again.
Well, thanks a lot. Bye-bye.
My guest has been Marc Faber, publisher of the Gloom, Boom, and Doom report online at gloomboomdoom.com. He was speaking to us from Chiang Mai, Thailand. Coming up, John Kaiser, next on This Week in Money.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Kaiser from Discovery Watch. John was at the PDAC Mining Conference in Toronto. John, welcome to the show. And how was the attendance at PDAC?
Well, Jim, I am glad that I'm back here in California where the virus is circulating, I suspect worse than in Toronto. Attendance this year was 23,144 people. That's down 12% from last year. To put this into context, my stats go back to 2010. It was 22,000 that year. Now that was, PDAC is in March, first week of March, so the attendance reflects the experience of the past year. In 2009, we weren't sure that we were going to really recover from the thrashing the resource sector got in 2008. But then gold went on its tear, and it peaked in late 2011. So 2012 was the all-time high of 30,147, and that's 31% higher than this year. The worst was 2016 when it was 22,122 in that whole post-2009 period. So the question is, why did 2,700 less people show up this year, even though gold is the highest it has been since 2013? Now, Sunday used to be the big day when retail investors come. And I have a suspicion that even though since 2016 we have had a trend of increasing attendance, it has not been the retail investor. And on Sunday there would be the newsletter writer presentation. They would start at 8 o'clock and finish at 5 p.m. And in the good old days, I've done it I think for 20 years until this year when I wasn't invited, when you would finish your talk, you'd usually speak to a full audience. Then you'd be swarmed afterwards when you exited the hall, and people would, bug you with questions until you ran away for your next week meeting. Now, last year, there was nobody. In fact, for the last 5 years, I would do my talk to a partly filled audience and leave, and there would be nobody following or waiting outside. And even last year, I was like the second last presentation with Reaugh, the final one. We talked to only 75% of attendance in the hall. So clearly, the retail investor has not come back. Now, where you have seen growth is in the whole sustainability business. The PDAC's quite concerned about the image of mining, so there are lots and lots of these pseudo-government type entities there discussing topics. And unfortunately, the type of delegates that this attracts have about zero interest in the junior investing space. Now, if it's not the retail investors suddenly staying away because they've been staying away for several years, why the decline? I do think that the coronavirus had a big impact. People like Eric Sprott were calling for the cancellation of PDAC. I think that would have been a disaster. We are not sufficiently advanced enough in the transmission cycle for there to be any serious danger. But the PDAC was very proactive in dealing with it. For example, there was one person whose only job was to stand by the escalator holding a rag soaked in disinfectant on the rail as it passed by. When you went to pick up your access pass on, say, Saturday, they had this bank of iPads all sitting there, and you were supposed to touch the things the choices that you were making. And I said, oh, great, a wonderful disease transfer station. But the staff there were actually doing it themselves so that you were minimizing contact. And in the first couple of days, there was all this concern about the handshake. The PDAC's a great place to retransmit germs from around the world by shaking people's hands. First there was the elbow bump, and then the fist bump. But towards the end, people had said, screw it, and people were just shaking hands and saying, a sort of a fatalism had gotten in there. And the Canadian Stock Exchange, it came up with a very clever way of marketing itself. In that access pass bag that you got, they had something that looked like a highlighter with CSE written on it, but it turned out to be a sprayer of hand disinfectant. So this was something cool to have in your pocket that wasn't going to spill or leak. You would just take it out, spray your hands, and periodically disinfect it. And every booth had a hand sanitizer bottle there, which people were using, periodically. Now, so I made it back from this pretty well, and I thought, oh great, well I think I did okay. So I get off out at San Francisco Airport, get onto my parking shuttle, and I'm sitting there, and then I watch this multi-generational extended family come on board, absolutely filling my shuttle, and half the women are wearing face masks, and I see this airport, duty-free shopping bag, and it says Bangkok. And I said, oh, great. I just survived PDAC, and I probably got nailed in the last mile.
Well, that's the thing about germs. They're so sneaky.
Oh, and to make it worse, the bus driver thought he was doing us a favor by turning on the air conditioner.
Sure, the best thing he could have done was open the windows. Because germs overall, hate fresh air and sunshine.
Yeah. Anyways, I'm hoping that I was just being in a foul mood when I sat there staring at this crowd of people who just come from an overseas flight from Asia.
Well, best of luck to you there, John.
I'll tell you in 14 days.
Boots on the ground at the mining conference, what were you hearing from the delegates?
The PDAC is so much more dispersed than it used to be, and there's a huge number of exhibits there, and the kind of mixing that used to be a character of it, where you would pick up buzz, it's not quite the same. I didn't pick up any sort of big picture themes such as a major new discovery or anything like that. My own style of dealing at PDAC is to sort of walk around. I have a number of exhibit booths that I wish to visit, and I have all these chance encounters with people. So for me, it's this extended serendipity journey where I just pick up tidbits of this here and that, none of which are worth sort of really saying, oh, wow, I picked up this great story. There's this wonderful, fantastic gold deposit in Indonesia or something like that. No, it was nothing like that. I can't report anything. But one question that kept coming up was, oh, John, how are you doing? And it wasn't that simple icebreaker thing, or nor was I interested in my health. The question really was, how are you coping with what some say is now the 10th year of the Resource Junior bear market? And I would say, well, I think I'm starting to fit the definition of insanity by doing the same thing over and over again, expecting a different outcome. And invariably, the response from the other side is, I know how you feel. So the mood was really one of, when is this ever going to end? When are we going to get back into a proper bull market? And, even though there was this general mood, for me personally, I was quite excited because it was like a kid being in a candy store. The valuations of these companies are so low, the story's so interesting, and at least for gold, the upside outlook is so strong that this is probably the best time ever in my career to be looking at these resource juniors. And I know I said that in early 2016 and was almost right and figured that would be the last bottom fishing list ever I put out. Well, I think right now is an even better time than back in that PDAC in 2016.
What were the other takeaways from PDAC?
Well, one of the things that the Prospectors Developers Association is starting to pay attention to is the aging demographic of the mining sector. Last year, the youngest boomer turned 55, and if you're 55 and over, the Canadian financial establishment deems resource juniors as unsuitable for your portfolio. So this whole group of people are in a sense disqualified from investing in resource juniors unless they have an account with a discount broker and are on their own. And another question is then, so where is the younger audience that's supposed to replace the boomers and the greatest generation, or what I call the post-boomers, which are the Generation X, the millennials, and the Generation Z called Gen Z. What do we need to do to bring them into this space? And, of course, some of the topics that the mining guys were talking about, how do we coax people to pursue careers in the mining sector? I mean, one of the things that was terrible on the Sunday was at the South Convention Center and Trenton. All these protesters had showed up complaining about mining, saying mining is bad, stop mining, which is absolutely dumb. Now, admittedly, the mining industry has a horrible history of abusing the environment and everything downstream, but that has changed today. I mean, there's a completely different environment. However, there are parts of the world where mining is still bad, and this young people attitude to stop mining in jurisdictions where the rules are pretty strong and tough, and permitting cycles are quite difficult. All they're doing is transferring the mining to jurisdictions where the downstream victims have no voice whatsoever, and that's a sort of a form of stupidity or downright evil for these young people to have this attitude that mining is bad in general. So, the PDAC is working hard on changing the image of mining, explaining to people that, there are sustainability issues and the companies are dealing with it. But bringing those retail investors back that have disappeared, bringing this younger generation into the resource junior space, that is something that PDAC is also starting to think hard about. And so I've started a post-boomer club, which is a free educational platform in part of my website, targeting people who are younger than 55, and it's part of my campaign to bring this audience that really knows very little about this space into the fold and teach them the 3 Gs, glory or greed, good, and glory. And the post-boomers are particularly well suited or interested in all 3 of these emotional factors. And boomers and older, they've really only been interested in the greed part. How much money can you make owning a resource juniors? So showing people how to make 10 baggers, maybe even 100 baggers out of resource juniors is a key part of the educational process. But the post-boomers also are interested in the good part, which is impact investing. So if they pick something that's going to go up 10 times or more and make a bunch of money, that fulfills the greed emotion. But if the success of the company also creates some broader, longer-term general good, well, that's a bonus. So they'll focus on something like that. So highlighting companies where success goes beyond just enriching the shareholders, that's a key part of attracting this younger audience. But it's the glory part that's most interesting. My generation, the boomer generation, all that, if you wanted glory in this resource junior sector, you became a stock promoter or you became a newsletter writer. And stock promoter, well, that's a highly specialized game, and it has changed. And but the newsletter writer business, it's become very difficult. There's lots of competition. Nobody wants to pay it. There's a big entry hurdle. So how do you become an influencer and enjoy the glory of being able to influence others in the current environment? Well, social media has changed all that. And this is something that we need to point out to the post-boomers, that the resource sector actually lends itself very well to become an influencer where you can actually profit from owning these shares and influencing other people's perceptions of them without you having any sort of fiduciary duty to them. They need to be made to understand this. And I have a subscriber who caught the greed bug back in that 2010-11 rare earth bubble when he saw the stocks go like way up 10, 20, 30 times in price. He felt the good part about it because as somebody considerably younger than the youngest 55-year-old boomer, he's quite interested in the long-term impact of raw materials related to like climate change mitigation, and he saw that future rare earth supply is going to be very important to this. But he also gets into the influencer, the glory part, by having a Twitter handle which is called Junior Explorer, which he uses to share his thoughts on that. And so he was the rare post-boomer actually at PDAC on Sunday, visiting companies, asking intelligent questions, and he's built up, he became a subscriber 4 years ago and has been busy learning how to think about this space. And he has a full-time real job. He's already familiar with the glory part. It's a sales-related job, but now he's in here doing research. He does it in his spare time. He has no desire to go into business as a newsletter writer or get some job with investor relations. This is his entertainment. It's his way to make a whole bunch of money, and we need to have more people start doing this thing. But there's a problem. The Junior Explorer is not an accredited investor. He does not have a net worth of $1 million outside his equity in his primary real estate, and he doesn't have a job that churns several $100,000 of income. So he cannot, at will, at his choice, invest in a private placement. But a trust fund baby, dumber than a bag of hammers, is completely entitled to invest in anything. So this is economic class discrimination. So the regulators recognized this problem several years ago and invented something called the existing security holder exemption, which says, okay, we're not going to apply any sort of financial wealth standard to you, but we will restrict your purchases to $15,000 worth of stock per company per 12-month period. And I said, well, that's fine because, somebody who isn't a millionaire shouldn't be throwing around huge amounts of money, and diversity is a good thing. You don't want to go all in on one little junior. So this was a very positive development, but the existing security holder requirement makes no sense whatsoever. And they have this great disclosure system, 43101 and all that. I use it to research companies. If a company announces that it's doing a $500,000 financing, a private placement with a unit, a warrant at 5 cents, why should a non-millionaire have to already own the stock in order to be eligible? That individual should be able to just go to the website, go to CDAR, look up all the documents, decide, yes, this is a great story, pony up $5,000 and get that piece of the action, put money directly into the treasury. We need a diverse array of juniors in this resource junior ecosystem. We can't just boil it down to a few dozen companies backed by the power groups. We need all these small companies that are struggling, trying to do real stuff, to be able to get those initial dollars from these small investors. And these small investors are going to come from the capital pool of post-boomers. So something that the PDAC should really get into is pushing the regulators to get rid of this restriction and then continue to encourage the education aspect. How do you teach people to invest in resource juniors, how you can make all this money, and get that audience coming back into the resource junior space.
We'll have more with John Kaiser when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with John Kaiser. John, is investor psychology changing for the junior mining sector?
Well, Jim, the problem is that the investor psychology changed in the last decade from quite supportive and enthusiastic to quite negative. And part of the problem is that the realization that every mine has a valuation limit, defined by the tonnage and the grade and the price of the metal, and it's going to have a 10 to 20 year mine life, maybe sometimes longer, and that's going to create an upper limit to the valuation of the project if everything comes into being as hoped for, starting with the grassroots area and then a target and then discovery delineation and so on. This is very different from the winner-take-all psychology of cannabis or technology, where one company could end up winning the entire space, and we have no idea how big the space's value can get. So in the beginning, everybody is a contender, and you can't argue that this one will be a loser until the race is much more advanced. So the audience out there looks at the resource sector, sees a bunch of gobbledygook published by the companies, doesn't understand the size of the prize, doesn't even know what a fair, and even if they do, don't know what a fair price is to pay for something that's just an exploration target right now, but the footprint of the target and the setting is such that it could be $1 billion ore body that comes out of it. And so the attitude is, well, I'll stay away from this sector until we have gold blasting through $2,000 and becoming that tipping point where suddenly it's a momentum game again, where you don't need to know anything except maybe have rumors about new buying coming in from somewhere, and trade it like some sort of cannabis or technology space. But my attitude is, we've been waiting for this to happen for a decade. We may be on the threshold of it happening, but maybe it will take gold a much longer time to get through $2,000. I'm of the view, actually, that it will go through a lot quicker, but I'm also of the view that we need to teach people how to bet on these juniors. So not many people know how to quantify the size of the prize, but let's say you have $1 billion potential prize and it's a target. Well, your uncertainty or certainty of it becoming reality is 1 to 2.5%. Very few people understand that the way you price an uncertain outcome is to multiply its value by the certainty. So 1.5% to 2.5% is $10 to $25 million as fair speculative value for $1 billion prize. If you've got 100 million shares fully diluted, that's a price range of 10 to 25 cents. If you can buy the stock at below 10 cents, then you get good speculative value. And if it's between 10 and 25, it's fair speculative value. The post-boomers need to be taught how to think in these quantitative terms, actually take advantage of this upside valuation limit of the resource junior space in order to engage in a form of gambling that's not just momentum-based, but that's actually fundamental outcome-based. And otherwise, we're never going to get rid of this negative psychology of waiting for the crazy breakout in a metal price that allows any pig or turkey to fly.
Are you bullish on the TSX Venture Exchange and the CSE, the Canadian Stock Exchange, or do you fear the so-called PDAC curse will hit them this year?
Well, the PDAC curse, which is the tendency for whatever uptrend we develop in the first couple of months of the year to fall apart right after the big convention in Toronto, it actually kicked in the week before. We had a pretty good year of increasing traded value at the January show in Vancouver, where I was. The mood was very ebullient, not like it was at the PDAC, which was far more subdued. But when the big markets finally started to get their correction, as the market realized this virus has a big economic disruption problem in China, and it's going to replicate itself in North America and the rest of the world as this virus spreads, we started to see a sell-off, and the attitude was similar to 2008. The whole thing's going to fall apart, and so people started bashing out the stocks that they had. Now, they didn't bash out shares in zombie companies. Half of the 1,200 TSX Venture listings have negative working capital. They owe about $2 billion. The other, slightly less than half, have about $2.5 billion. And these were the ones that were starting to trend up this year. This year was looking really, really good. But they all got hammered badly. I myself am quite bullish that this year will turn out to be the beginning of a major bull market for the resource sector, not just gold-related juniors, but also the broader sector. But right now, post PDAC, the value traded has dropped back below $20 million. It was up in the sort of $40 to $50 million range. It was like between 10 and 15 million in early November. Now it's like everything's gone very quiet. The market is paralyzed. It does not know how bad the rout in the senior equity markets will become. So we are in a holding pattern. And I would say now is the time to go out there and start buying these better companies which were trending higher earlier this year, which have been knocked back by this thing that has nothing to do with them. This is not at all like 2008 when it was the entire financial system that was falling apart, that was going to harm 100%. This is just a haircut for the 1%. Could get as bad as 30%, but that hair will grow back.
Is money starting to flow back into the junior miners following the run-ups into the marijuana and cryptocurrency juniors?
Last year was really bad. Until about December, things started to pick up in December. And the odd thing was the gold uptrend started in May. And it's been really a head-scratcher is why has the broader audience not embraced the resource juniors in light of gold coming from, $1,300 level, and it's touched almost $1,700, and it's now, ranges between $1,550 and $1,700. Why has more money not come in? Now, there's been players like Eric Sprott, who's been liquidating his Kirkland Lake shares and spreading it amongst a large range of juniors which have good and interesting stories. But we haven't seen tremendous follow-through by a broader sector. The institutional money is still focused on a very narrow segment of the market. And the brokerage industry, well, because of the way it's changed into this fee-based asset management character, it's not really that well suited for money coming in. So if companies are going to raise money, they're going to have to track down high net worth investors. But those ones, because they're high net worth, they're also looking at this, their other assets getting a haircut. And of course, they see their bond holdings go up in value because the yield is collapsing towards zero. But they also worry, well, what if this ever reverses? Then these capital gains in my bonds, those are going to vanish also. So right now, they're not in a particularly good mood to pay attention to the juniors. So we are now in a stalled limbo, waiting to see how this virus unfolds in the United States and in Canada and in the rest of the world.
Millennials were said to be active in the marijuana and cryptocurrency markets. Once the junior mining sector breaks out, do you think the millennials will be there for them?
The millennials, we talk about them not being in the resource junior space, but they were very much into the cannabis space. In fact, Americans through Robinhood, which is this almost a free trading platform that you can trade from your smartphone, that was actually the engine that drove a lot of these stocks, these Canadian weed stocks that managed to get interlisted in the U.S., helped drive them to the stratosphere. But it was all momentum-based trading. Now the question is, what is the trigger price for gold that will bring millennials into this space? And is a move through 2,000 enough? The fact that finally we have a new high for gold, is that going to pull them in? I don't know if they will come in until it's like doing very, very strongly. It's like Bitcoin. Only sort of fringe people were investing in Bitcoin. It wasn't until it started going exponential and going to insane levels that we started to see the millennials pile into the Bitcoin and then pull in a lot of other older investors also. So that's a tough question as to what it takes to pull them in. This is why I think the better added approach is to show millennials how you gamble on fundamental outcomes of a finite nature. That, I think, really is the key to pulling them in, educating them on how an exploration target could turn into something 10, 50, maybe even 100 times more valuable.
Could any of the junior resource sectors benefit this year from supply and demand issues?
Well, the big markets are selling off because they're seeing the big supply chain disruption in China, which is rippling through to the rest of the world's economies, all of whom depend on components manufactured in China. Now there's the concern that if it starts to go really viral in the United States, we will see similar draconian actions to shut down the movement of people and goods, which would disrupt the American economy. And of course, as the economy shuts down because of these measures to try and contain the spread of the coronavirus, that kills demand for raw materials. And we can see that in the price of oil. It's dropped below $47 a barrel for WTI. And that's a big problem for the shale oil fracking industry because they don't make any money for that. And there's a huge amount of debt that needs to be rolled over in the next 2 years. So we're going to see a wiping out of all these bonds that these shale oil frackers have issued in the past decade if these oil prices persist being low. And with all these other metals, copper, nickel, all of them are weak right now. The warehouse stocks are piling up because the metal isn't being needed to make stuff. So from a demand perspective, this is a bad year. But there's other ways of looking at it. One way is to look at the possibility of security of supply type problems. China has a potential serious problem in that if they have not succeeded in containing this coronavirus, and right now it looks like things are starting to move again in China, but if this reverses and it goes on another leg of spreading and causing trouble, the very leadership, the Communist Party of China, could end up being endangered. And one way to deal with that sort of problem is to create a distraction, the old wag the dog story. And one of the things that's always bothered the leadership is Taiwan, an island that's supposed to be part of China and which China declares to be such. And it's got a plan to annex it by 2040. Well, why not, if there's this virus also going crazy in the United States and pissed off Chinese are starting to be disobedient and causing trouble in China, why not annex Taiwan right away? And all of a sudden, the United States has a serious conflict with China. Well, a whole bunch of stuff comes from China and goes to the rest of the world. So we could have these structural supply disruptions of a lot of materials required to keep the economy humming in the rest of the world. And so we could see interest develop for non-precious metal type plays, even though the nominal price for the metal makes the project still not very interesting. The potential for the world to get fragmented into smaller trading units with different prices for these different regions, that adds a strategic value to these projects. So supply and demand type issues could become part of this whole story.
Due to global uncertainty, trade wars, and now the coronavirus scare, could we see gold and silver spiking to new all-time highs?
Well, last year, I was already of the view that gold is facing a repricing into the $2,000 to $3,000 range. And this was based on uncertainty related to the trade war, to a different stance that the United States is taking relative to the rest of the world, dissolving of the globalized trade system and the idea that the United States is the peacekeeper for the entire world. As all this was starting to unravel, as populist governments were destabilizing the situations in individual countries, I expected gold to reprice into $2,000 to $3,000. But now, with the coronavirus as part of the equation, I think it's a slam dunk that this will happen this year. And this will be a very significant move, and it's not very good for, base metals in general. But if this situation does spin out of control, especially the response, the virus right now is nowhere near as deadly as the Spanish flu was back in 1917 to 19. The mortality rate is only about 2%, and it targets a specific demographic, which would be older people who have health issues. So if you exclude that part of the population, the mortality rate is considerably lower. But the response to it, the fear, the hysteria, that could be economically destabilizing, and all hell could break loose in all sorts of quarters. Now, if this starts to happen, how do you put this all together again? And I'm of the view the only thing that the United States can really do in an environment where they end up slashing interest rates down to zero, and which will basically accomplish nothing in an end times mentality where now we have the coronavirus as a symbol for this end times mentality. The way to restore the future is to tackle a problem that people have been talking about for more than a decade, which is infrastructure renewal, which is fiscal stimulus, something that the gold bugs have always hated as good old-fashioned Keynesian stuff. And this is going to have to be done, whether it's the Republicans that do it or the Democrats that do it. It will create jobs in the United States. It will signal to the rest of the world that the United States sees a future. It isn't just one of a shrinking light at the end of the tunnel. It's one of light expanding at the end of the tunnel. It gets the potentially very dangerous conflict between post-boomers and the boomer generation. It gets rid of that conflict. And also, it will turn around this expectation that the economy is going into a global downturn and that's going to be bad for metal prices. It will stimulate interest in the resource junior sector. It'll get metal prices going strong again, because the whole build-out of future mine supply has kind of been premised on relatively weak global economic growth, with China's growth slowing, the United States not really growing in a big way, and India never quite reaching that tipping point that China reached in 2003, which spawned a super cycle. So gold will make new highs. Silver, I don't think will make new highs, because it would have to go over $50. A move over 2,000. Well, we're pretty close to that. Yeah, I think this is the year that gold makes it through $2,000 and then establishes a trading range between 2,000 and 3,000. And I think the market's seeing this happen and then coming to the conclusion that gold's not going back to 1,200, 1,300 or so. That's going to be the key to bring people back into the resource junior sector, because it's going to be in a very low interest inflation environment. And of course, gold, which doesn't yield anything, is now competitive with zero yielding bonds. And a simple move into that $2,000, $3,000 range is huge in terms of lowering the bar for what counts as an economic discovery, and also those ounces in the ground that weren't any good at, say, $1,300, $1,400 gold. The leverage is phenomenal. And when the post-boomers start to understand that like a 25, 30% move in gold can have a 1,000% leveraged impact on the value of a deposit that a company already owns, that's when they start seeing that logic, and this was what drove the super cycle into the copper deposits and all that. This is what's going to really make the resource juniors flourish.
Overall, are you bullish or bearish on Canada's junior markets for 2020?
I am generally bullish, but in the back of the mind is this nagging fear that what if this thing, which is not anything like the Spanish flu, doesn't get controlled and undergoes a mutation? The Spanish flu, which ultimately killed 50 to 100 million people, had two waves. The second wave was far more lethal than the first wave. It was the proliferation it underwent in the first wave that enabled the virus to mutate and then do very, very serious damage in the subsequent year. The other thing to worry about is, well, right now it's targeting people who are health-wise compromised in some way. The Spanish flu was deadly in that it targeted young adults whose immune response is what killed them, not really the virus itself. Older people who had more enfeebled immune responses, they tended to survive. So it is the risk that this thing gets out of control and mutates into something more lethal. That's in the back of my mind, saying, well, if that starts to happen, then, resource juniors, they're dead. But I'm going to remain an optimist and hope that they get this under control. It will die down, and I think the resource juniors will have a very good year this year.
If I gave you $1 million to invest today, where would you put it?
Well, I would refer you to my post-boomer club, which currently has about 10 companies, all representing different aspects of the junior space. I would say and of course I would say, I hope that isn't all your money that you have. If that's maybe 20%, 20% of your asset base, good. Otherwise, cut that down to say 100,000. You put you don't put all in on this sort of stuff. Leave most of it in your more conservative positions that aren't going to do too much either up or down. But yes, spread it amongst a range of companies such as FPX Nickel, Midas Gold. I have a whole bunch of them there. You can find them at the Post Boomer Club. Things like Niobe Metals, maybe Critical Metals, Verde Agritech. These are stories where you can get the greed and the good together. The success of these things has benefits that go beyond enriching the shareholders. Look for those types of things right now in this current environment. They're all on sale, but only temporarily so until this whole coronavirus thing blows over.
John, you live in California. Do you think your next car will be electric?
Well, my problem is I'm an empty nester, or supposed to be an empty nester, and my garage is full of stuff. So there's nowhere to plug in an electric vehicle. But personally, I like that I can fill up my car with gasoline pretty much anywhere, and that it only takes me 5 minutes. So personally, I won't be interested until that range anxiety and then having to waste several hours to recharge. When that's gone, then I'll definitely get an electric vehicle.
John, how can people find out more about Kaiser Research?
Go to kaiserresearch.com and look for the Post Boomer Club Resource Center link on the homepage.
John, thank you so much for being on This Week in Money.
Thank you, Jim. You're welcome.
And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Marc Faber, and John Kaiser. If you have any questions for our guests or for the show, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money. Now stand by for a company showcase update from American Manganese CEO Larry Reaugh.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, great to be here.
Larry, how is the coronavirus affecting American Manganese operations?
Well, naturally, markets affect any company that trades on the exchanges. And so that's negative. But another way that it affects us is we were going to be speaking at a conference in Washington State in mid-month, and that has been canceled. And I can see that happening everywhere. It makes people reluctant to travel and reluctant to put a group in a room and where you could spread the virus. So I can see that, people that plan these conventions and are probably pulling their hair out because they've spent hundreds of thousands, if not millions of dollars setting up a conference. These are bigger ones, not the one like in Washington State, but they'd still have spent a lot of money and effort to put this conference together. And, and there's going to be a lot of cancellations that I can see coming up, and that's going to hurt the industry somewhat. with emails and with the internet, you can still carry on a lot of business like we can. We're still getting a lot of interest in what we're doing. But getting out there and telling the public about it is going to get tougher and tougher over the next couple of months. But we've got a great story. We've got some big ambitions here. We're going to be starting to look probably predominantly in the U.S. for the siting of our first plant when we finally get that thing financed, and get our designs and everything else, which I think will certainly help the financing abilities of it. But we've got to start looking for a location, and it's going to depend on a lot of things. It's going to depend on the environment in the area, what do we have to meet. We're very confident that we can meet the requirements of any environmental study because we have a closed circuit process that puts nothing back into the environment, so that's a big plus for the company. And so that's one of our goals that we're starting to work on. And if anything comes in the near future, we'll be talking about that. And we've pretty much are getting close to completing the testing that we're doing for the other Tier 1 company. And I would hope that we'll be announcing the results of that very soon. So that's another big positive for the company. We're arranging to travel to the Netherlands to meet with our potential or our MOU partners, and I'm just hoping that nothing interferes with the schedule on that. But that is also a dicey area that. International travel is going to be really very restrictive, and it could be harmful to your health. So we have to think about those things. We don't want to send people into areas that may, affect their health, or result in sickness or death. That's one of the things that concerns every company out there. Like, for example, the PDAC had about 10% drop in the number of attendees, but the attendees I talked to figure was much greater than that because one of the big tells at the PDAC is that you always had to line up for about 10 minutes to get an escalator to move between levels. And at this latest conference, you could walk right up to the escalator and go up and down. So that tells you there was a very big reduced amount of attendance at that conference. And this is going to, kind of go throughout the industry. There's probably going to be, as I said earlier, there's going to be cancellations of some of these conventions. And but aside from that, we're looking at a very positive picture going down the road. And the battery shortage that's occurring right now because of this, not just because of this, it was actually happening before the coronavirus, and so that's affecting the production of EV cars. So you'll see a pullback in that production, but that, in my opinion, is temporary. And the Mining.com has come out with an index on the critical metals that are involved in the lithium-ion battery space, so that people can follow the prices and everything else that are going on, and look at the charts and see that the chart is looking excellent. So that's a big plus because otherwise people were kind of in the dark on how do you evaluate the amount of critical metals that go into a battery, and what are they worth? And what I want to remind people of is that when we first looked at that, the price of the metals were all in much lower than they are today, and it still looked robust to us at that time, and that's why we decided to proceed.
not only for the environmental benefits, but if you can't make money, you can't work with the environment. So that's one of the big things off of our shoulders. I see that even though people like to criticize me for talking about predator trading, there's 2 videos attached to this podcast that talk about predator trading, and it's not me talking about it. And I encourage people to look at it and see exactly, what I've been talking about for the last 6 or 7 years, and which is now going mainstream, especially with the Save Canadian Mining effort that's going on, and that's what these videos are all about. But I'd like to remind people that when you don't have a uptick rule or a short rule, that it affects anything that trades on the Canadian exchanges. It's not just mining. So the outlook is good, and I see that GM is coming out with a new battery that will challenge the 390-kilometer battery that Tesla uses, although I don't see how that's going to affect sales for either one of them, and because the GM battery has to be commercialized and tested, over a few years before it becomes mainstream. But I don't think 10 kilometers is going to be a big incentive for Tesla to beat them. But I know that Tesla is always trying to get more kilometers, more miles out of their batteries. And all these things are very good to us, for us. And, the rigs for setting standards for batteries is something that should be put up there. I mean, China is talking 98% recoveries, and which is very similar to what we talk about. And but at least it's a goal point for you. And I think that this is something that should be adapted in Europe and North America. Certainly, we fit that bill, and that would help us in our endeavors, and and we've got patented processes. I keep reminding people of that. Those patents are the real value in the company, and that's something that they should realize. The Cametco has just finished up a big job, which was 10 to 20 times larger than ours. And so now they can start focusing on some of the stuff we're doing, except for the the testing work that we've continued to do. And then I hope to have some results from that, such as a costing for doing a preliminary economic evaluation, and for maybe running the pilot plant again at full capacity, as Norm says, until it chokes. And so I'm looking forward to that. So we've got a lot of things on the plate, and we're just trying to keep ahead of the game. And the coronavirus has happened at a bad time, but if it was going to happen, it's probably going to be over with. Hopefully very soon, and we can move on.
Larry, for people new to American Manganese, what's the company all about?
American Manganese, critical metal company that has several patents, and the first patent was on low-grade ores, which is going to be crucial to the United States, critical to the United States at some point in time, and that was a cornerstone of our technology for lithium-ion batteries. We moved quickly on that, and thank God we did, because now we have that process patented, and it's a mining process that was developed over 80, 90 years, and we completed that circuit in 2010. So it's a company that is focused now on lithium-ion battery recycling. We've got good results on that. You can go to our website and look at all of the reports that we have on there, and the transparency of everything that we've done. We're not trying to hide anything behind anything, and these are not results that were achieved by some lab people working out here in our office. It's something that was arm's length, so we've got their arm's length reporting on that, and we still have a lot of interest in that. We trade on the Toronto Venture Exchange under the symbol AMY. We trade in the U.S. under the symbol AMYZF. And we trade in Frankfurt under the symbol 2AM. Our website is AmericanManganeseInc.com. And you can reach the company by emailing me at LREAUGH@AMYMN.com. Or you can phone the company at 778-574-4444.
Larry, thank you so much for the update.
Thanks, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on March 6th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.